Welcome to the Mortgage Broker Podcast, tailor-made for Canadian mortgage industry professionals. Proudly presented by A Better Way Mortgage Group, this podcast is your trusted source for insider insights, market updates, and strategies to elevate your career in the ever-evolving world of mortgage brokering. Whether you're a seasoned broker with A Better Way Mortgage Group or an industry enthusiast looking to stay ahead, our episodes are designed to empower you with the knowledge and tools you need to excel in the Canadian mortgage space.
Okay, we're back for another episode of the Mortgage Broker Podcast. We are really excited for this one. This is our first lender episode, actually, and we are excited to announce that Pierre Martin, Vice President of Mortgage Lending at Home Trust, is here to join us today. He took a helicopter all the way from Toronto this morning just for this show. We're happy to have you. Appreciate you taking the time for this. We're going to talk about the current and future landscape of alternative lending, a little bit of quality of borrower in the Home Trust book of business, default rates, a little bit of AI utilization on the Home Trust side, and some predictions there. Pierre is going to hit us with one thing that he thinks a broker could implement into their book of business based on what Home Trust is currently utilizing internally. And we'll finish off with a couple notes on the acquisition of Fairstone and also Home Trust pulling out of the A space. So I will turn it over to Mr. Pierre. If you could tell us a little bit about yourself, a little bit of background in the industry. And Jason brought this up this morning. I didn't know, but you actually had a big transition from the underwriting side of the business over to sales. So,
well, thank you very much for having me. I appreciate it. And the helicopter ride took me all night, so I haven't necessarily slept. I'm on my third coffee, so hope I'll be good today. I would say my entire career, over 15 years, has been, I would say, an underwriting operation. And Jason knows well because we even worked together at a company.
Sorry to hear.
Yeah, I know. Well, that's why we had to cross paths, and then we have to run from each other for sure. No, he's a great guy. When I came to Home Trust, I was the VP of underwriting there. And I think 2 or 3 years in, I think you three and the leadership team at that time thought it would be a good idea and a good experience for me to go to the sales side, which I accepted. And to be fair, it was supposed to be a secondment, which that's what I really do appreciate about Home Trust. They think out of the box and they try these things with, I'm not the only one who did a secondment, but which helps grow your career, learn other things. So that was really interesting for me. And after 6 months, I kind of enjoyed it. And now I'm like full time, and now I'm going to be 3 years in the job. It's like flipping the coin, but it's still mortgages. And I think the biggest advantage it for me anyway, and I think for the company, what it brought, I think we're much more stronger on the sales team now in terms of knowledge of underwriting. But I also bring in the aspect of I'm going to use maybe the word empathy, but also understanding each role. I think that's what we've been trying to get. So it cultivates, I would say, a teamwork between sales and underwriting. And since I've taken over the sales team, what we've implemented, we have one side what we call the inside sales, and the other side what we call the outside sales. And realistically, one of the things when I arrived, what I found interesting was we're in a servicing business. When you really look at it, yeah, we do mortgages, but at the end of the day, we're in the servicing business. The ease of the process, that's really what we're trying to achieve. And one of the things is, as a salesperson, your first key role is build that relationship, but being able to answer the phone. And there are too many accounts. That was what really happened. Our BDMs had too many accounts and weren't really keeping up on the phone. So we kind of segregated by saying, okay, everyone's going to have what I call a top 25 account. Big brokers, big agents. This is what you need to deal with. And then with other brokers that are much smaller or need a bit more work in terms of efficiency and training, and anyone that we onboard, we went into the inside sales where we curated a program, a 4 or 5 course. When you get onboarded, you have to go through it to understand who's Home Trust, how to package an alternative deal. And the inside sales are really there. They're not necessarily on the road. They're there on the phone. You call them, you ask questions. They're there to help you package the deal. So what we found by doing that is the BDMs had much more time to really focus on the big accounts, pick up the phone, visit them, do training. And what we saw from that is our efficiency ratio really went up. So that's a big win there on pretty much.
I mean, I think you hit the nail on the head, and it's a very good move. I think the one potential challenge, if every company was to educate on the back end and then go to sales, some people just don't have that sales skill, right?
For sure. I think it was a good fit, and I thank the opportunity, as I said, from you sir, and other leadership team. To your point, I think they probably saw that I was not that bad in communication and creating creating a relationship with brokers. So
a certain set of skills.
Yes. Yes.
No, that's cool. And I've always thought about that from the brokering side too. Like there's a lot of people that get into the industry and they're just out there trying to sell, but they really don't understand the minutia. And to me, like that's a recipe for disaster, right?
100%.
And it's hard as a new broker, like you're going and trying to talk to realtors and financial advisors to get business and you really don't know what you're talking about, right? So I've always thought you should find a way to learn the business inside and out, even if it means working for someone for a bit, and then you can hit the sales harder because you're educated on it. So just, I guess, to get into a little bit of the alternative lending landscape, I mean, there's been so many changes over the years, conventionally, alternative space. Obviously today we're going to focus on alternative, but, it's been interesting. We've seen a lot of changes, like a couple to rattle them off. We saw the rental offset, for the most part, go away in the alternative space on a subject property. We saw, the 6-month bank statement stated income program ripped away. Most lenders need 12 months nowadays. So, those are concessions that you give, obviously, because of, regulators probably putting pressure on you. At the same time, I think probably across the board, I know that there's a little bit of minutia behind this, but I think for the most part, we've seen, in BC anyways, we've seen a lot of our lenders either stay stagnant from a policy perspective, or we've seen a lot of lenders come to the table with higher debt service ratios, larger loan limits, right? Which is, to me, it's interesting when you're dealing with an environment like we are today, higher rates, probably higher risk for default, and you're seeing lenders adapt to try to help borrowers. Maybe you can touch on that a little bit.
Yeah, no, for sure. So maybe to your initial first question, to your point, it's no secret. I think probably a year and a half ago, 2 years ago, OSFI had a meeting and invited all banks. Basically, and in that meeting, they announced, I would say, a couple of changes where they would like to see more of, and that's where it came in. I would say the bank statements as an example. So traditionally, they'll tell you should be reviewing for self-employed as an example. Your income is via 2 years of NOA. But within the recommendation, they said you can substitute the NOAs as an example. They did say that they'd rather see an NOA just to make sure, but you can I'm going to use the word substitute, if you can prove a sustainable income stream. And that's where the bank statement came into play. So why 12 months versus 6? Realistically, it was to counter seasonality. That was really what it is. In 1 year, you can see if the business has a season or not, up or down throughout the year. That was really what it is. And I think it got implemented fairly quickly by all lenders. So the regulation is definitely, I want to use the word tighter, because their role is to make sure that they build a sustainable environment for lenders when you really look at it, and more importantly, to protect the customer. I've had a lot of questions around, I've seen other lenders or even ourselves that you're tightening up. I don't think the word tightening is probably the correct one, meaning our risk appetite and our guidelines have not changed. Realistically, how I say it is the environment's changed. So you get riskier deals. So when you get riskier deals, well, all of a sudden, my risk appetite hasn't changed. I just review it that way. So that's really what we've seen so far. Definitely, the market for purchases has not been the greatest when you look at it. And then the refinances, at one point, the rates, you're basically going from people on at one point 2 to 3%, and now you're offering 7%. Like they've doubled the payment, tripled the payment. And when you have clients who have a 500 beacon score and they're requesting 70, 75, or even 80% LTV, and you've doubled your payment, that's a higher risk. The profiles change. My risk appetite hasn't, but the environment that we're putting into in where they're going, that's really changed. So that's where I think what we're seeing. To the other the point that you said, example in BC, and we've seen it also in Ontario, when you said other lenders are extending their ratios and things like that. To be fair, we've always had them.
Yeah.
So for us, I would argue they're trying to catch up more than anything else. And I think for the last 40 years, Home Trust has proven that how we manage our book, how we review our applications, to your point, you're talking about default rates, we have a very low default rate. And so we've been capable to prove to everyone, even with lower beacon scores and higher TDS. Higher TDS is technically on our book is not a symptom of default, meaning it doesn't equate you got higher TDS that you got a greater chance to default. We haven't necessarily seen it.
Well, that'll transition nicely into our next piece. But before I go off this topic, I don't know if you would have this stat or not. Do you know from a brokerage or broker perspective if efficiency ratios have decreased over the last? Yes. I mean, to speak of riskier deals coming through, you're declining more files, right? So I would imagine, and I know talking to a lot of alternative lenders, like efficiency is not great with an alternative lender. It's typically, I mean, you can speak to this better than myself, but I've heard like 50% is good.
50%, I would even argue, is amazing in alternative lending. To be completely blunt, like we're pretty transparent in our Spire program out there, which is the compensation program for brokers. We clearly say that in order to move up or even to be considered as an onboarded broker, you're supposed to have a 33% efficiency. Some people would say that's low. Yeah, compared to the prime side, 100%. Sure, like your prime, and don't get me wrong, I've done a lot of prime in my career. Also, it's gone to a point where it's a ticking a box more than anything else. You've got a good rate. Does it match what your guideline says and all that? You tick, and you're good, and you're good to go. And prime clients have the choice. So realistically, alternative lenders have less choices and solutions out there. Even though I think the market in Canada has evolved, and we're seeing more and more alternative lenders out there, which is good for brokers and good for customers. It's it's more solutions out there for sure.
So I guess just moving into, we kind of touched on this, but quality of borrower, I wanted to bring this up because I think there's a major misconception, especially from the general public's eyes. Like brokers might have a different view on this, but from the general public, when they hear about a home trust or an Equitable, if they're not in with that type of lender, they probably assume it's a very, poor credit, high delinquency type of book of business, which from my knowledge, it really isn't that. Obviously, there's a component of that comes because they are a higher risk borrower technically than prime. But maybe just to get rid of that misconception, like what kind of quality of borrower have you guys typically seen?
It is a very good question. And I think alternative lenders have evolved with their environment over the years. And one of the biggest impacts is in 2016 when the Department of Finance made some decisions around not allowing insured refinances, maximizing your amortization, and more importantly, the self-employed side of it. You had no choice. If you want to go on a prime side, you had to prove your income via 2 years NOA, which in all fairness, that was a big help for us because we took that market. And realistically, our average beacon score is above 700. Like it's like 720, 730.
Crazy.
Depending. And again, we were a publicly traded company, so every quarter we would say it. So when you look at it, our quality of our borrowers are very, very, very good. And as I said, our default rate is very, very low. And the reality is because you're dealing with a lot of self-employed who cannot get a prime lender, and they pay well. They work hard. We have a unique way to review the income. It is a stated income, but we back ourselves with the bank statements in order for a cash flow component of it. If you're going to tell me you make $300,000 in net income, on your self-declared letter, which we also ask them to provide their financial, when I say stated financial statement, tell me how much your gross minus all your expenses and how much you net. We look at the bank statements to correlate them, to justify that exactly. Because at the end of the day, if you're going to make $200,000 and your bank statement only shows that you're averaging not even $1,000 a month and there's nothing going in, how do you justify that you're going to make $200,000? And that's the reality there. But they're really good borrowers. So
yeah, I mean, I could add my 2 cents on that from the years of brokering. Some of the highest net worth clients, some of the businesses that made the most money landed with a home trust or an alternative lender. And, there's always typically you want to have an exit strategy to help the client in the long run. And we've had clients over the years that have just chosen to stay with a home trust or, any type of alternative lender, because the alternate is, you're claiming massive amounts of income and there's cost that comes with that. And I think they just like the flexibility and understanding that comes with an alternative home trust type lender, right?
No, for sure. For sure. And to your point, our risk appetite is very broad, meaning that, to your point, you've got self-employed with high beacon score, high net worth. We do loans, very large loans. We're known for that. We have even a specialized dedicated team to review those type of deals. Revenues, higher than $500,000 as an example, with loan amounts that can go $4, $5, $6, $7 million. We do them. We do them. And those type of profiles are very good profiles.
Do you know what the largest loan Home Trust has ever done?
If I'm not mistaken, I think we signed off on between 11 and $14 million. Wow. We did once, yes.
I wouldn't like that payment.
Bridle Path in Toronto.
Interesting.
Yeah.
So, Pierre, I know you've kind of briefly touched on default ratios being low. I kind of want to dive a little bit deeper onto that, just for a couple different reasons. One is for the general public that listens to this. I mean, you could ask people on the street and they say, "What's the default ratio?" And they go, 40%, 30%. I've even been to conferences where that question's been asked, and brokers will even put their hand up if a lender says, "Do you think it's 20%?" And the hands go up. So, statistically, I think we've seen about a 0.16% default average. Now, I know that is trending up, and that's for a multitude of reasons, but can you maybe touch on what the actual default ratio is and how many mortgages actually go to default? To me, the real number's very low and kind of quite staggering. So it's going to be interesting to hear your thoughts on that.
Yeah, no, for sure. And here's the thing: it's also public information, meaning anyone can access it. So you've got the Canadian Banking Association as an example, the CBA. So you just go on the website and you click on it. They tell you what's in Canada every quarter, what is that number? And I think, I haven't checked it for a while, to be honest with you, but we're talking about 0.2, 0.3 here. Like when I hear even 1%, I'm like, not even close. Now, having said that, for the longest time since COVID, those numbers were really, really, really low. Like historical, when you look at the last 20, 30, 40 years, super, super, super low. Have we seen it increase? Yes, every lender's seen it. If you follow the industry and some of the company out there publicly traded, they provide that information. And it is, most of the time, a question that has been asked. It's still very manageable. Is it higher than what we saw? It's in those ranges today.
Well, it's interesting too. And as low as that default ratio is, some of that ratio is accounting for people that have actually passed on and have not paid those payments, and not just people not paying. So I guess a big question too is, given the fact that it is very low, it still does happen. So how does Home Trust deal with consumers when they actually go into default?
That's a very good question. And I think that's why we've seen also our numbers not necessarily going up. First of all, borrowers are resilient. They are changing their lifestyle in order to ensure that they pay the mortgage. That's number one. I think what we say at Home Trust, and I'm going to probably use a phrase that Ushri has said many times, our goal is to provide a home. When I say provide a home, is to be able to provide them with a mortgage and for them to buy a home. But we also want to keep them in their homes, and that's where it's key. That is our thought. So we're not there to kick people out when they go in default. We're there to find solutions. Different solutions can be deferrals. It can be increasing your amortization. It can be renegotiating the rates. It can be doing a refinance, and we've done that. And we've also, for more, I'm not necessarily say extreme cases because I don't think that's the case. It's more for people where there's a cause and what's the cure, meaning what's their exit strategy, as you mentioned over a couple of minutes ago, is they want to sell the house, but the market is not necessarily the greatest. So we offer what we call a PIT. Basically, we capitalize the interest and the taxes up front, so they don't have any monthly payment, and then it allows them for 12 months to basically sell. So we only do that for existing borrowers. And again, we don't do that for everyone. Like I want to make sure that is not a program there. Oh, I need it because I can't make the payments. So what we did create a specialized team in order to review those type of applications. So they go through customer service. Customer service asks some questions. Yep, I can't pay. Then it goes to the specialized team. We do a full financial review. So we do ask some questions, and we do ask to provide them the bank statements. And from that type of information, we try to find a solution for them. Again, we're trying to keep people in houses. That's our goal.
Well, I think it's great. I mean, the fact that you have, multiple different channels or angles that you can go to help the consumer if they do go into that default. I mean, as a broker, I would feel confident working with a company like Home Trust for that very reason, because we want to make sure that our clients are covered and taken care of front to back. So I'm going to flip gears a little bit here and talk about something that is, obviously been hot topic for across the world, really, is Home Trust utilizing AI? And if so, how are you doing that?
I think we're exploring that idea like everybody else. And what is AI really? When you look at it, we're a simple business. We do mortgages, right? And when I say we do mortgages, I'd like to say we're a servicing company that offers mortgages, but realistically, we offer mortgages. And that is a product that's been there for centuries when you really look at it. So where does AI can support that? And I think where we can see AI is example within the process. So I'll give you an example. We're going to implement follow-ups as an example. So at Home Trust, we have also our BDMs that do a lot of the follow-ups when we've committed a file. So you'll get a call, hey, it's been 4 days, 5 days, just following up, has your client made a decision, yada, yada, yada. So what we've utilized is AI to have automated emails go out, but personalizing the email based on the AI and the profile of the client. So as an example, that's helping us within our process. That's what we're doing. The other thing we've done is we've created an AI, literally, we call her May. So it's for maison in French, home, maison, May. And basically, we go in there. She has all the information of guidelines, processes, and things like that. So under, as an example, I'm no longer going into a PDF and searching and trying to scroll down. We literally go in our computer and we go, May, can you please tell me what's the guidelines for rental properties? And May will go and tell you. So we're using that now as an example, which is great. We're using it also in some meetings where, take scribes. Can you give me the information? Or we take a text. Can you give us the 5 points out of it? So I'll give you an example. We do surveys each month based on to all brokers when they fund a deal and they interacted with the BDM. So we're really big survey guys. We want to listen. We want to hear the feedback because we want to get better. And we do that survey and we get about 100 responses each month. A lot of data. To be fair, we took that data, we threw it to May, And May came up with a summary of here's what's going well, what you need to do better, and things like that. So it really helps us to speed up the
So
time.
what you're telling me is May is not going to take your job.
No, never.
May is going to help make your job more efficient.
That is exactly it.
Gotcha.
Can we borrow May?
Maybe one day.
For 5
I don't know.
No, that's really cool to hear. And we like to ask these questions, right? Because the whole industry is going to change and adapt. And, even there's tools, on submission platforms, Velocity and whatnot, that discovery where you can ask some questions. So yeah, it's good to see. And I think it'll make brokers' lives easier. But I also know that in my opinion, there's never going to be a world where brokers are pushed out of the equation because there's so much minutia and so much client interaction and emotion handling that you need a human being involved in that. So
you always need to. And again, there's AI and what we call also automation. So we're big on that we're on the next, I would say 2 to 3 years, we're focusing on that. As I said, that experience. How do we make it better for brokers and customers? There's a lot of automation that we're trying to put in place that speeds up the process. But to your point, it's not to make a decision. We still need underwriters. What we're trying to create is provide the information quicker at the fingertips of an underwriter to make a decision, but you still need an underwriter to make the decision. Yes, we will see maybe at one point, even in alternative space, what we call automated conditional approval as an example. Can a commitment be out based on the information you provided? The answer probably is yes. But at the end of the day, it's not for every profile. So at one point, you always need a human being.
Yeah.
But more importantly, you got the commitment, great. Who's reviewing the docs?
Yeah.
You still need a human to review the docs anyway, and if we have to re-underwrite the file.
Yeah.
So to your point, it's there to support, help, but it's not to take people. And I think it's the same concept for brokers also.
Yeah, definitely. Okay, so you've had a lot of insight into the home trust business from the underwriting side to the sales side. So I like to ask this question to as many people as I can. But if you could pull one thing that you've learned inside of the home trust kind of culture, what would you pinpoint as something that a broker could implement into their business that they could benefit from?
I think it's a very good question. I think there's a multiple answer, but you said only one.
Only one.
Only one. I think what we've done for the last couple of years is we've made decisions based on data. Right. And I think data is important and it helps to make the decision. Example, we've expanded lending areas in some areas, example, BC, Alberta, and Quebec. And that's based on data. Data that we have, data on our books, but also data from external parties. And it helped us to say, we're missing the boat in some of those regions and we should be in that region. We should be lending there and taking, I would say, I hate saying riskier profiles, but that's the reality. But I think also data right now, when you look at your book of business, what always amazed me is the renewal side of it.
Yeah.
There's more and more lenders out there, and I know we're one of them. We pay our renewals.
Yeah.
Brokers can get involved. And that is data that is so key, easy to access, easy to build using different CRMs out there. And we know in 2024, but more importantly in 25 and 26, it is going to be the largest book to renew, prime or even alternative.
Yeah.
So for me, if you're not using the correct data and CRM and processes in order to tap in that, for me, you're just losing revenue.
Yeah. I mean, we scream this from the rooftops constantly. So I'm glad you brought that up. It's, brokers that have been doing this for 10, 15, 20 years, even if it's been 1 year, like if you're not tracking your data, you're losing out on business every single year. And then you wonder why you've had a tough couple of years,
That's
right?
correct.
Like, whereas if someone that had been properly managing their data and their database and communicating with clients, like renewals are one thing, but just staying top of mind for people that are going to move halfway through term, right? So anyways, absolutely. That's top of mind for us constantly. And I know a lot of our brokers are putting a lot of work into that too, which is we get a lot of good feedback from people that are actually taking action on this and they're getting calls like a week after they start communicating with their database, right? So yeah, that's bang on. Appreciate that.
Yeah, no worries.
Yeah, I'm quite confident May would have given you the same answer.
Probably.
So two major announcements that's come up in a little bit. I'll ask you kind of both of them at the same time. You pick whichever one you want to start with. But one is the acquisition of Fairstone.
Okay.
Any comments around that? And then two is kind of where I want you to go with it first is pulling out of the A space. So, Home Trust Accelerator, what happens when these mortgages come up for renewal? So some thoughts around that.
Yeah, no worries. And, we're, as I said, we're very transparent on it. It wasn't a secret. I think we hope, and I really do think we communicated correctly. We gave enough time for people to know. Realistically, why the prime profitability wasn't there. Like, simple as that. When you really look at it, what's really important is, we might no longer originate prime business, but we still have a book and we still service the book, and that's what is key. We haven't decided to pull the A and say, oh, by the way, our existing customers on A, you're all by yourself, you're on your own, tough luck. We still service them. So that's really what's important. I think for brokers, we're going to take care of your clients, and that's key. And to be fair, we've just seen our main competitor do the same. They just announced it 2 weeks ago. And to be fair, they're going to do exactly the same as us. They are going to service the book. So I wouldn't worry at all on that end, realistically. And that's also an opportunity for brokers. Call the client, have a conversation where you're at in life, and do we need to do anything there? Concerning Fairstone, business as usual. We're going through the formal process to get the final approval. So that's where we're at. But realistically, you're going to expect the same service, the same quality of service, the same people, because they're two different companies, meaning they complement each other. One is more at a personal loan, unsecured, and we're secured lending. So we complement each other. Yes, Fairstone is a direct-to-consumer. They have 250 branches out there, and they have over 2 million customers, for sure. When you look combined Home Trust with Fairstone, I think we'll be around the 2.3, 2.4 million customers. When you look at it, it is a big base, for sure. But we complement each other.
Yeah.
So business as usual.
Just on that topic, and I mean, this is not necessarily Home Trust related, but it's acquisition related. In the last little bit, we've seen some pretty drastic acquisition, at least offerings out there. RBC and HSBC, National Bank and Canadian Western Bank, and now there's comments around Nesto and CMLS. Whether you want to dive into this or not, I mean, do you have a couple comments on why you think? Because I've been in this industry for 12 years, and I don't think that we've seen this many massive decisions being made in such a short period of time. Do you have any comments as to why you think that might be?
That's a very, you know what, we've seen it. I think the last couple of years we've seen acquisition that makes sense.
Yeah,
makes, I would say, the industry stronger. I know for us, when Stephen Smith bought. When I say Stephen Smith, his company bought us. Stephen Smith owns 100% of Home Trust, and now he's merging Fairstone. He's also a major shareholder in Fairstone because he wants to make it better, stronger. But he's always top in mind brokers and customers. What can we do in order to support, help them? And I think those big mergers are opportunities for, to get bigger, better, and stronger.
All right. Last question here, a bit of a rapid fire. Tell us, in your opinion, the most commonly used product at Home Trust and why you think that is.
I think there's two. It's what we call classic and ELV. There are alternative solutions, and even I would argue our ELV, equity line Visa, basically it's a credit card registered as a mortgage. It operates like a HELOC and has all the benefit of a credit card. And I would say that product for the last 2 years has been booming.
Really?
It's been crazy to the point where at one point, I'm not going to lie, we're taking 10, 15 days to respond on how the volume came in. The reality, it was a great product. It's in second position behind any lender except privates, but any lender. And our rates at that moment were, they're very, they're super low compared to a credit card. Today we're from $7.99, $8.99, $9.99. Those are the type of the rates that you could potentially have in our book anyway. And you have customers who have a prime mortgage at as low as 2%.
Yeah.
And they still have 3 years renewal. And if they break it, they'll get a 5 or 6%. Well, put a second behind us at even at $8.99 or $9.99. When you look at the blended rate, it makes complete sense.
And that product probably helped a lot of people that didn't qualify on the prime side get through a tough time.
We've seen larger amounts, and the quality of the borrowers, like FICO score as an example, going up. To your point, we've seen traditional clients at a bank level coming to us and saying, "Can you give me an ELV of $300,000, $400,000, $500,000, $600,000?" Because even the traditional bank weren't providing that.
Well, and you guys have the ratios that allow for that, and I mean, even 100%. Through a conventional bank, you're stress tested at 8%. Like it's just not realistic, right? At that point,
that's correct
for most people.
Yeah, we allow to go up to 60%. That's a traditional mortgage for us. So it to your point. Yes.
Yeah. Oh, that's good. That's great to hear. Well, that's it. I really appreciate your time. That was a lot of great insights. I don't have any further comments, Jason?
Yeah, I mean, obviously, I've had the pleasure of working with you, and seeing you go from the underwriting side to the sales side. I know probably why you're decent sales guys, because you're working with me for a bit. But
I got all my tricks and tips from him. That's why.
No, I mean, you're an awesome partner of ours, a great guy, and we really appreciate the partnership we have with yourself, of course, and Home Trust. And yeah, I mean, looking forward to a lot of continued growth and success with you guys. And yeah.
No, and again, thank you very much for the opportunity today. You're definitely great partners of us. Anything we can do to help and support, we'll do it for sure.
And we will let you know.
Thanks.
Appreciate it.
Thank you for tuning in. If you found value in this show, please subscribe to our channel on your preferred platform. We're available on Spotify, Apple Podcasts, and YouTube. Your support is incredibly appreciated. We also welcome your reviews and feedback, which are crucial in helping us deliver outstanding educational content. Feel free to share your thoughts. A 5-star review would be fantastic if you think we earned it. Lastly, a vital announcement about Backpack Buddies, our chosen charity for 2024. This remarkable organization addresses a hidden hunger issue many are unaware of. In British Columbia, while school districts provide meals during school hours, numerous children face food scarcity at home, particularly during weekends. Backpack Buddy steps in to support these vulnerable children, ensuring they have easy to prepare, familiar food for weekends. This is achieved through collaborations with schools and an extensive distribution network. Your contribution can make a significant difference. With just $20, you can give a child in need a food bag from Backpack Buddies filled with enough meals and snacks to sustain them over the weekend and more. Once again, thank you for listening, and see you on the next one.